Welcome to All That Matters, a conversation show about markets, investing, and the world. My name is Mike Antonelli, market strategist with Baird, and with me, my partner Ross Mayfield, investment strategy analyst with Baird. Ross, it's the fifth episode. I believe this is our fifth episode.
Right.
Just the summer of 2023. Uh, kind of a slow part of the year. I thought we would talk about what really matters right now, like in the spirit of our conversation show here. What matters in SEP 2023? What do you think matters?
Yeah, coming up on Labor Day, like the official, unofficial end of summer, right? And so then things really ramp up into year end. What matters right now? There's a lot of moving parts, and maybe because it's been slow, no one big thing like the debt ceiling or AI anymore is like grabbing markets. But I think of all the stuff that's swirling around, what has really mattered lately has been interest rates. Rates have been spiking. The short end of the curve, that's the Fed. We're used to that. But even on the long end of the curve now, you've got like the 10-year treasury had pushed up to cycle highs, even with inflation down from 9% to 3%. And rates, I'll let you explain it, but they impact the economy, they impact the consumer, they impact stock prices. I mean, it's a catch-all, and it's been the thing that I think has driven August to maybe be a little weaker than the rest of the year. But why don't I see what you've got on rates real quick?
So it's an interesting term, right? Rates. What does that mean? Like some of our listeners might not even know what we're talking about. They may not know what short end means. They may not know what long end means. Let's just broadly define rates as the interest rates in the United States of America, basically the treasury market, right? So there's super short stuff that you might invest in. There's super long stuff that companies and corporations and government entities might invest in. Rates is just a term for the interest rates of the United States. And those interest rates, my friends, are determined by market participants and economic forces and currency differences and all these different things that go into rates. And rates have been rising recently, which Ross had just mentioned. Why have they been rising? Well, frankly, they're rising because expectations about our economy are starting to ramp up. They're actually starting to go higher, not lower. There's a tracker called Atlanta Fed GDP, and that tracker thinks next quarter's GDP is going to be roughly 5%, Ross. 5. We're about 2 this previous quarter. So when growth picks up, the market worries about inflation, and then these rates that we're mentioning start to rise, and that hurts the stock market. Ross, the stock market has pulled back. Is it rates, or is there something else? Is it a little seasonality here, right?
Yeah, sure. August and September, tough months historically. So while we're recording now, we're not really out of that seasonal rough patch, but I think rates are the driving force, and you hit on it. It's just, well, number one, for stock prices, you've got this competition for dollars, right? If a short-term treasury is yielding 5.5%,
It's
less
tough.
people want to buy stocks. So the price you're willing to pay for a share of a stock or a share of earnings should probably go down, right?
It should, right? If remember, your money's fungible. Your money can go anywhere. And for you to say, I want it in the stock market, you're saying, I think I can make more there than I can just buying a risk-free instrument, just buying a treasury bond or a treasury bill. So your money's always being competed for. And as those rates go up, it just makes it more attractive. Frankly, Ross, remember how the Fed was punishing savers? Now they're rewarding savers. Like the yields you can get now in short-term instruments and in bonds is much more attractive, which makes your kind of standard wealth management 60-40 portfolio better now. The 40% part, the bond part, is a little bit better. Ross, I made a tweet about kind of the things I was worried about. Rates was one of them. Here's a couple more. Let me just get your takes on these. Growth. Remember, I mentioned that growth in the economy was accelerating. It's probably peaking a little bit. While certainly it accelerated in the spring and the summer, it's probably peaking a little bit. So that what we call rate of change, that growth that kind of starts to roll over, is probably one of the reasons the market's a little bit more tepid. That seasonality we mentioned, and then offsides. Ross, to start the year, everybody thought recession. Everybody thought just bad economic outcomes. All those people have eventually moved over to the side of, oh, maybe there isn't going to be a super bad outcome this year. Maybe that's further out. So we've that movement of people into kind of our camp, right? The more of the soft landing, the more kind of no landing camp is probably done. So that you get that kind of offsides trade done, Ross.
Yeah, I mean, sentiment was super bearish at the end of last year. And even really up until the beginning of the summer, you had the regional banking stuff, the debt ceiling stuff. But once we hit summer, it really flushed the other way. People got really bullish. And so you lost that sentiment as an asset. But on the economic growth thing, I mean, maybe it's just being perma bullish, but look, I mean, economic growth slowing without going negative is what we need, because if growth doesn't slow a little bit or come in, the Fed is just going to keep hiking rates. I mean, They lay that out at their Jackson Hole conference. They lay it out every time they talk. If growth is too hot, if it's too aggressive, they see it as inflationary, and then they're going to keep rates higher for longer. So going all the way back to the beginning with rates, you almost need this growth to kind of land in a sweet spot where it's not overly aggressive, but we're not in recession. And quite frankly, we're on the path to that. But it's why something like growth peaking and slowing, the labor market cooling, like that's the kind of stuff where it's bad news, but it's also good news because it pulls the Fed, or it takes the Fed's foot off the gas at a minimum. And you kind of need that for a soft landing, I think.
Well, all these things Ross and I are talking about, they're definitely related to the economy as a whole, right? Rates is related to the economy, the Fed, all this stuff, inflation. It's just, how is the economy doing? And you might think it's doing poorly because, Ross, I've seen like news stories where like 6 in 10 Americans think the unemployment rate is a problem right now. Meanwhile, it's at like a 5-decade low. The news might not tell you that things are doing fine, when in reality, in the aggregate, home prices are still quite stable. The economy is still quite stable, if not growing, continue to grow. The job market's very stable. All these rates things that we're talking about are all dependent on the economy. And what Ross says is correct. We don't want it to grow too fast, which sounds weird, right? We don't want it to grow too fast. We don't want the economy going too fast, Ross. We don't, right? We want it to grow at a certain pace. But that's what we're dealing with right now in September of 2023. We're dealing with this. How's the economy doing? And is that affecting rates? And if that is, how is it affecting the stock market? And that might not sound very sexy, Ross. That's not all that interesting. It's not a major global event. It's not something real fancy, but that's what's happening.
Yeah, and I want to touch on your point about people thinking the economy is not doing as well as it is. Again, it's number one, it's always an aggregate, right? I know there are people doing better, there are people doing worse, so we have to kind of look at it at the 30,000 foot view. But the other piece of data I wanted to point out quickly was the conference board does a consumer confidence survey, and consumer confidence kind of plummeted in August in a really recent reading. But within that report, they asked people about their future plans for spending. People are planning at a higher level than almost ever to go on vacation, to travel internationally, to buy things like cars. And I've seen people talk about this, it's the everything is bad, but I'm doing fine. Right. I think there's a lot of that still going on, even with, as you mentioned, the unemployment rate at 3.5% and things continuing just to kind of truck along, some headwinds, some tailwinds.
I mean, just to kind of wrap this up, things are they seem mostly fine right now. There's obviously things to worry about. There's things that are better. I think the economy continues to chug along. And Ross, now that summer's winding down, let's kind of end this on a light and airy note. What kind of stuff are you reading right now, watching? Like, I want to get some ideas of stuff to watch and read. I have a couple things that I want to talk about, but what are you watching, reading? What's going on in your life right now?
Yeah, well, I was gonna do song of the summer, because what's going on in my life right now is a lot of Disney tunes. I've got a 2-year-old,
yeah,
so
let's go.
Mickey's Clubhouse, 65-second
that
song. It's like a TikTok length song. It's 65 seconds. I've heard it about 100,000 times. So that's the song of the summer. What did I just watch? I just watched The Fugitive for the first time.
Great.
What do you think? Harrison Ford, pretty good. So we're going back a little bit. There's not as much new stuff starting to come out with the strikes, I think, and so we're kind of digging into the archives. But yeah, all time Harrison Ford. What about you? What are you watching? You're a pop culture guy. I want to hear your takes.
I'm a huge pop culture. I love to write about pop culture. I love to podcast and video cast about pop culture. There's this podcast called The Rewatchables, where this team from the Ringer podcast network, they look at old movies and then they kind of talk about it for an hour or so. They just did National Lampoon's Vacation, the original one, which you might be a little young for that one, but it's an all-time classic. And then you know what I've been doing, Ross? I've been going back and watching old movies, like classics. I'm like, well, let me see some of these classics I didn't ever watch growing up. And I'm a 49-year-old, so I should have seen these. I watched Casablanca, which holds up, incredible movie. And then I watched The Godfather Part 2, which is generally considered one of the greatest movies of all time, basically. And here's a take for you guys, and you, Ross. The Goodfellas is one of my favorite movies about the mob, and Godfather 2 is certainly the same. I think Godfather 2 is a better film, but Goodfellas is a better movie. Does that make any sense to you?
Yeah, Goodfellas is, as like a movie, it's more of a ride, like highs, lows, right. Like a lot of like needle drops, great classic songs in Goodfellas. But yeah, probably like a little less, probably not going in the Library of Congress, whereas Godfather 2 actually might. So, or maybe is.
It's like a bit of a pretentious take, right? It's like this is a better food, but that's a better appetizer. I don't know. Like it just Godfather 2 seems like a better film in the artistry use of the word. But old time movies, that's my thing, Ross. It sounds like you'll get through this Disney stage. Believe me, I remember Disney's Mickey Mouse Clubhouse constantly too. So
we're pushing Pixar hard. We're trying to at least get the quality stuff to the top, but it doesn't always stick.
Well, thank you guys all so much for coming for our 5th episode. Certainly plenty to think about, plenty to chew on right now. There are some things that matter. It's maybe not as crazy as it's been in a while, but there are some things that matter. So stay tuned for episode 6, where we talk about some more of what matters for you. So Ross, good to see you again.
Thanks. Talk soon.